The last part is yield curve. So yield curve is a graph of the yield to maturity, YTM, as a function of term to maturity, so short term, long term. So for yield curve, usually you have X and Y, right? Like this. And this is short term and long term. So this is time to maturity. And this is yield. So this is time to maturity, this is yield. Time to maturity yield, time to maturity yield, and time to maturity yield. Based on the economic situation, the shape of yield curve changes. This shape of yield curve is usually as a normal, but the other yield curve is actually the signals of the bad market expectations. So that's the expectation of bad economy usually. So what determines the yield curve? First of all, there is a hypothesis called expectation hypothesis. So suppose everyone in the market believe that, well, the current 1 year interest is 8%. What about, and next year it will rise to 10%. And what about, say, Y2, 2 year interest investment? So suppose we don't have any preference about the maturity. Suppose you invest $100 today, and a year later, you will get $108, right? Because 8% interest. You invest 1 year more, now you have 10% interest, right? Right, which means that you're gonna have $118.80, right? So it means that your $100 investment now for 1 year, say Y1, and the second year, say expectation R2, will be same as 100 investment 1 plus 2 year investment for 2 years, right? So it means your $100 and 1 plus Y2 for second 2 years will be, it should be 108.80. And if you solve these, then you're gonna have 8.995%. So expectation hypothesis believe that you should have long-term investment. Eventually you have the balance after all. That balance should be the same as the rolling over short-term investment. That's expectation hypothesis. So this case, suppose you buy, zero coupon bond, say face value $1,000. Current yield to maturity, Y1 is 8%. So this $1,000 plus 8% interest, so it's going to be $925.93, right? Suppose that you have Y2 equals to 8.995% interest for 2 years. So this is 2 year bonds yield 8.995%, so square, zero coupon, $841.76. Okay. Now 1 year later, so you hold this bond for 1 year, year later, now you believe that new interest, YTM at year 2 equals to 10%. Then this bond price will be 1,000 divided by 1.1, right? Equals to $909.09. Now let's calculate this bond investment, like a holding period return for 1 year. So you have 909.09 minus 841.76 divided by 841.76. And if you calculate this, this will be 8%, same as this Y1. So it means that it's basically believe that 1 plus Y1 plus 1 plus expectation rate of second year will be same as 1 plus Y2 square, right? And this expectation rate is called the forward rate. Forward rate. So you have this formula. So from previous one, we have 1 plus Y2 square equals to 1 plus Y1 times 1 plus forward rate second year, right? We have another example, third year one. So suppose you have 7%, 6% Y2. So 2-year rate, 3-year rate, same 7%. What about forward rate third year? Then we can have 1 plus 3-year rate, so third equals to 1 plus 2-year rate squared times 1 plus third year forward rate. So 1 plus, so forward rate equals to 1 plus, now 7%, that's why 3, to the third, 1 plus 6% square minus 1. So it will be 9.02%. That will be the forward rate. So expectation hypothesis believe that well, the rolling over short-term rate should be the long-term rate. Now, is this hypothesis hold? I mean, does this hypothesis hold? I mean, is it right? In fact, we easily see that investors prefer the short-term bond and the demand risk premium on long-term bonds. Why? Why? Why long-term bond has higher risk? Because one possible explanation is people, investor like liquidity, investor like liquid asset. It means that investor require longer term asset because of lower liquidity level. So this is called a liquidity premium. You may require liquidity premium for long-term bond. So new forward rate will be this expectation hypothesis forward rate plus liquidity premium. So examples show that suppose that the short-term rate of interest rate is currently 8%, and that investors expect it to remain at 8% next year. If we don't have any liquidity premium, your forward rate, it will be also 8%, but it's possible that you require 1% liquidity premium in increasing the forward rate 9%. Then what happens is your second 2-year rate will be 8.5% based on the expectation hypothesis, which means it's a little bit higher than 1-year rate because of liquidity premium. Makes sense, right? Makes sense. So yield curve will be upward sloping because liquidity premium is in the price of long-term bond. So if you look at this yield curve, if you have expected short-term rate combined increasing, right, and then increasing liquidity premium, then you have high, sharply rising yield curve. However, if you expect the short rate is declining and liquidity premium is constant, then you have hump shaped. So depending on the expectation, you have different kinds of yield curve. Usually this rising yield curve is normal one again. The other yield curve, inverted one, hump shaped one, flat one, is kinds of signals for bad future. Bad future. So this spread, so this term spread is the difference between 10-year bond yield and 90-day yield, that all treasuries. So risk level of the default is quite similar, right? But there is kinds of the liquidity premium and also the the market expectation, usually inflation premium. So if you believe the depressional economy, which which expect the bad economy, right? So then we have inverted yield curve, inverted zone, which means this spread is negative. So you focus on this blue line. This is differences, and there's some negatives here. Oh. And these negatives all bad days. 70s recessions, dot-com, Great Depression. I mean, Great Recession, not Great Depression, Great Recession. Meaning that if you find inverted yield curve, it means you have bad expectations. So because yield curve normally has upward slope due to the risk premium, a downward sloping yield curve is taken as a strong indication that yields are more likely than not to fall. The prediction of declining interest rate is in turn often interpreted as a signal of coming recession, okay? Short-term rate exceeded long-term ones in each of 7 recessions since 1970s. I mean, here, there, 1, 2, 3, 4, 5, 6, kind of 7, right? This is all recession period, actually. For this season, for this reason, it is not surprising that the slope of yield curve is one of the key components of the index of leading economic indicators. So this term spread yield curve is leading indicator, which means this yield curve predict the market, predict the economic situation. Okay. If you go to Wall Street Journal, you can always find yield curve every day. This is very important information. So once the inverted zone yield curve is found, then the stock market start to fluctuate, because now we know that the people believe the market will fluctuate. We will have a recession. Okay. So it's very interesting to compare the yield curve and the stock market reaction too. So this is the end of the chapter 10. Thank you for watching chapter 10. This is a long chapter. I strongly suggest you read textbook at least once, especially for the part of the first part, or the characteristic part, and this term structure of default risk and any like narrative part, actually, the conceptual part. The technical part is relatively not very difficult if you fully understand the prerequisite course, the FIN 331, because we already learned that. There's some differences, including we use Excel spreadsheet like the price function and get a flat price, invoice price using the price function, and also the yield function. Just practice using the provided spreadsheet. You can get, get it easily. So, and if you have questions, just let me know. All right. So again, thank you, and see you next chapter.